Hello and welcome to the Baird Trust Large Cap Equity 2024 First Half Portfolio Recap. My name is John Watkins and I'm a co-portfolio manager on the strategy. This first slide shows our performance track record. Q2 was another quarter of progress for the S&P 500 with a return of 4.3%, while our large cap equity, or LCE, lagged quite a bit with a return of 1.1% gross of fees and 0.8% net. That brings the year-to-date return for LCE to 14.6% gross and 13.8% net, which lags slightly behind the S&P 500. Market returns through the first 6 months of the year have been generated mostly by a handful of large technology companies, and our lagging performance can be fully explained by our underweight in the tech sector. It also can be fully explained by our not owning shares of one stock, that being NVIDIA. Regardless of the reason for the soft results so far this year, rest assured that embedded in the longer-term 10, 20, and 30-year returns you see here are many lagging quarters, just like this one, and some much worse. Our sole objective is to outperform the S&P 500 over full market cycles. We invest with a long-term business owner mentality, so we're always focused on multi-year periods rather than any individual quarter or year. We believe that in performance measurement, the longer the time period, the more informative the numbers. On the next slide, under the sector allocation on the left, you can see our large underweight in information technology that I mentioned earlier. The size of the underweight is a little deceptive in that we own shares of both Alphabet and Meta platforms that are included under communication services. So we do have a lot of exposure to the tech industry, and it has been very additive to performance over the last decade. Just taking a step back, it's important to highlight how we think about these sector allocations. First, our sector allocations are intentionally very different from the S&P 500. We believe that outperforming the S&P can only be achieved by looking different than the S&P. Second, we build our portfolio from the bottom up on a company-by-company basis, meaning our sector weightings simply reflect where we are finding investment ideas that meet our criteria, not any sort of top-down macro views. On the right, under the characteristic summary, notice the 5-year alpha, beta, and standard deviation that all point to our attractive risk-adjusted rates of return. The next slide shows the top and bottom individual holding contributors for the past 1, 3, and 5 years. In the past year, companies such as Progressive, GE Aerospace, Alphabet, JP Morgan Chase, and Microsoft were our top contributors, while Johnson & Johnson, CarMax, Omnicom, Cisco, and Expeditors detracted from performance. One important note here is that when looking at the longer-term 5-year contributors, the total returns of the top contributors are orders of magnitude larger than the quite small losses of the laggards. This is an important characteristic of successful long-term investing, and LCE has benefited greatly from this phenomenon. Moving on, this slide shows our recent portfolio changes. We made several changes in April. First, we exited our position in Pfizer and used the proceeds to add to our small position in GE Vernova, which was a recent spinoff from GE that coincided with the culmination of Larry Culp's multi-year turnaround efforts at GE. We believe GE Vernova is well positioned to be a leading beneficiary of the decarbonization and electrification of the world's economies. Second, we trimmed Progressive as it had gotten above our 8% position size limit. We used the proceeds to add to our position in CarMax. CarMax is currently going through a severe down cycle, but we believe they are well positioned to continue taking market share once the down cycle ends. And finally, just a few big picture comments. As I said in the beginning, this year's market performance has been bifurcated, with the largest technology companies, also known as the Magnificent Seven, generating more than half of the index return in the first half of the year. We are currently in a hype cycle centered around the promise of artificial intelligence. We don't know how long the current market dynamic will last. It could be nearing its end or last for several more years. But our aim is to remain focused on the long term and avoid getting too caught up in the moment. In fact, as more investor attention shifts towards AI-related companies, the relative attractiveness of other outstanding non-technology businesses improves. Ultimately, we will remain disciplined in our time-tested investment process by continuing to focus on finding investment opportunities that meet our critical criteria: business, management, and price. We believe this is the best way for us to achieve attractive long-term investment returns over the coming decades. That does it for our mid-year portfolio recap. Thanks so much for your time.